Welcome to the Beyond the Stock Market podcast, a Groundfloor production. I'm Brian Daly, co-founder and CEO of Groundfloor, a private market lending and investing platform that's done over $2 billion in volume. I've been challenging industry conventions and norms my entire career. And in 2013, I started Groundfloor with Nick Bargava to open up private market investing more transparently and to more people. This podcast features some of the sharpest minds in finance. This episode and every episode goes beyond the headlines to look at what's new, different, and exciting in the relationship between traditional finance and new opportunities. Today's episode is a really interesting one because we're stepping outside of traditional real estate and into another critical part of the physical economy, brick-and-mortar businesses, and how they access capital. I'm joined by my friend Michael Davis, CEO and co-founder of Homegrown, a fintech company focused on providing growth capital to independent operators like restaurant owners, fitness studios, and retail entrepreneurs. Michael started Homegrown after a decade in consulting, startups, and venture capital, including time working directly with the CEO of Deloitte, which I don't know if we talked about this. That's where I started my career.
I kind of
after
forgot
college.
that.
Yeah,
it's a great place.
So I loved that company. It was a great place to get a start. And Michael's company has a clear mission to build a better capital solution for operators who have historically been underrepresented by traditional finance. Michael, great to have you on the show.
Thank you so much for taking the time.
I'd love to start with the origin story. So what led you to start Homegrown, and what problem were you trying to solve?
Yeah, the beginning of Homegrown starts a very long time ago. I was 11 years old, and my parents decided to start a company. They did what many people do, which is they went to the bank and got a startup growth loan to open the business. Of course, it was personally guaranteed, and unfortunately, early on in that company's journey, it didn't really work out. And I got to see what happens when a family business, doesn't grow and scale the way you expect, and also dealing with all the consequences, personally that happened when a company doesn't work. And so my family, spent a couple of years contending with this, and during this time, I'm seeing the pain of the experience they had, and fortunately, they tried the same company again, and it worked. It's a really nice, very profitable business today. But along their growth journey, it was terribly hard for them to get access to capital. So even when the business was, generating a lot of revenue consistently, profitable, great management team, all these things you'd expect, was still nearly impossible for them to go to the bank and get the growth capital, the expansion capital they needed to grow. And I saw my parents frustrated about this for countless hours over dinner at Golden Corral for years. And I think hearing my parents share their frustration for so long probably left a little bit of an idea in my brain that I, 20 years later came back to in building Homegrown and trying to solve a little bit of the problem that they dealt with.
I get that. And I think when most people think about small businesses like restaurants or fitness studios, the assumption is that traditional bank financing is available.
Yeah, it is an assumption.
It seems like it would be. But what do people misunderstand about how these businesses are financed and why private credit can play such an important role?
Yeah. So Homegrown is nearly 3 years old. And I can remember the first months of that journey very, very viscerally. And one of the most common questions I was asked was, can't they just go to the bank? And this is an extreme misconception. What most people...
By the way, I get the same question about real estate.
Yeah, okay, good.
Because everybody thinks, real estate. You can finance real estate.
Just go to the bank.
And you say, what? No, it's really not that simple. And that's why there's a whole market in these finance categories that are non-bank lenders or non-bank capital providers.
That's correct. And there's a number of reasons why the kind of traditional finance layer doesn't always serve the needs of these entrepreneurs. Sometimes it's because, let's just pick on the banks. Sometimes it's because the banks have a credit culture and where they're not allowed to take, slightly higher degrees of risk. And by the way, I'm not giving them crap. They operate in a regulatory framework.
Sure.
And that's their regulatory framework. But that regulatory framework keeps them from providing capital to many businesses that are very largely creditworthy. So that's one issue. Then the other issue is the experience. So just to set the stage here on brick and mortar entrepreneurship, let's take one of our clients. It's a coffee company. They have 6 locations, about 140 employees. Did you know that? People think about a restaurant and they're like, oh, they must have 10 employees. It's like, no. Like, it's very normal for a single restaurant to employ 60 to 100 people.
Yeah.
And so now that entrepreneur is managing 60 people, maybe at one unit. Got a lot of part-time workers, full-time workers, kitchen staff, the overhead to manage the stores at all. And now you scale that up. So you talk to a 5-location operator, easily has 200-300 employees.
Wow.
And now you're going to have that person go to the bank and go back and forth for 5 months, going through a checklist, and it feels dehumanizing.
Right.
And I think that's the other part of the equation is like the actual feeling of going through the process of finding financing from a traditional kind of bank doesn't feel like it has hospitality, which you're talking to people who are like their lives are about hospitality.
Of course.
Yep.
That makes sense. I mean, there is a perception, I'm glad you voiced this. There is a perception that maybe brick and mortar businesses are inherently risky. I mean, restaurants go out of business. You do see retail outlets sort of suffer or struggle during tough
For
times.
sure.
But how do you think about the risk management in this space? And what is it that you saw that helped you develop confidence in your model?
Yes. So you know this very well, Brian. There's the kind of Main Street media narrative. And that narrative feeds on other mainstream media narratives. And in that kind of information stream, there's a lot of nuance that gets lost. And when you dig into the nuance, you can almost always find an exception. So our unique insight was actually born from this kind of statement of, oh, well, restaurants are really risky. And we're like, the pizza shop my friend wants to do is really risky. It's not that narrative is wrong. It's just that it's not correct all the time. That was the kind of founding idea with Homegrown. It was like, it's not that there isn't risk in real estate. It's not that there isn't risk in technology. It's not that there isn't risk in brick and mortar 4-wall entrepreneurship. There is risk, but there are zones where there is relatively lower risk. And if you can find those zones and contract with the people in that zone, you might have an opportunity. That's what we found. So let's go back to the restaurant example. Many restaurants are highly risky because it's not just building out the space or hiring the team. It's providing service that is highly unique to hundreds and hundreds and hundreds of patrons every single day. There's a lot of points where that can fail, right? Now, but what happens when you look at the restaurants and you can actually assess them? You can see, how did you perform when the pandemic happened? That's something we look at, by the way.
Interesting.
For businesses, we like to partner with companies that have a longer track record because instead of saying, well, what happens if a global pandemic occurs again? And it's all conjecture. It's like, I can actually go and do an analysis on your financials, your bank data. I can look at your customer reviews and I can talk to you and get a more complete picture of how do you handle these dislocating events.
I mean, that sounds like a series of signals and aspects of, sort of underwriting the risk or assessing the risk that might differ from how people traditionally look at financing something like this.
Yeah.
Right.
And I think to give a little bit of a description of Homegrown, we provide revenue-based expansion capital to proven brick and mortar businesses that have multiple locations. So going back
it's not
to
for the first time, your example, pizza shop entrepreneur who's trying to figure it out for the first time.
We are not that.
Right.
We I would love one day to have products for the whole range of entrepreneurs, but where we are right now, we're very focused. We're not startup capital. Um, we're not even early stage capital. We're acceleration capital. We're the capital when you have something that is working and your option is to go spend 300 to 400 hours raising equity, selling ownership in your business, going to the bank and going back and forth for 5 months, going to the SBA, um, and you don't want to do that. We are a far better option. And the underwriting we do is because that kind of echelon of entrepreneur wants a better financial product than what they get from their point of sale system that's giving them very short-term financing. Like they want more time to pay back. And they will tell you that I'm profitable, proven. Our customers love us. And I have 5, 6, 7 locations, maybe 10, 15, 20 locations, and they're working. I could go to the bank. I don't want to. I would rather work with you.
Yeah. So I guess you're saying the bank, it's not that the banks won't do it. It's that what it takes to do that with a bank might be distracting and pretty painful and maybe riskier for them actually.
Very cumbersome.
Yes.
Very cumbersome. And many of them will choose to take that path. In some cases, we are actually in partnership with the bank.
Oh, interesting.
Right? We're the best operators have a capital stack.
Sure.
Sometimes it's cash flow,
Yep.
sometimes it's equity,
Sure.
sometimes it's homegrown. There's a whole kind of
part of the equation.
Completely correct. And so I think when it's going back to the old question on risk, I think what we've looked for is fundamentally what companies where when you have as much information as you possibly can, are you saying like, why aren't they getting capital from the bank? Like those tend to be the businesses that we work with.
Mm-hmm.
And that's why our track record has been so good over, the first 3 years or so of operating.
So let's get into the products
Yeah.
a little bit, because I think the product is really interesting. I really like it. I like the way that it's structured and formatted. So I definitely want you to share that with the audience here. Can you just describe how you guys structure the capital? And then if you accept this as sort of a form of revenue-based financing, how should investors think about that as compared to a traditional equity investment or a traditional debt investment?
It's a fantastic question. So I am an equity investor. When I write an equity check, I don't expect any cash flow from that investment for a very long time. Sure, there are scenarios where maybe you get distributions after a period of time, but in many cases, you're not seeing any cash flow, certainly no material cash flow for a very long time. And by the way, to be clear, I'm talking about equity investing in the context of alternatives, not equity investing in the public markets where you have dividends and everything else. I mean like investing equity into a local brick and mortar business or a startup.
Mm-hmm.
That is an important part of the equation, the financial ecosystem. That's not what we do. We structured our revenue contracts. They're not loans, they're revenue contracts, almost in counterposition to the experience of traditionally investing in a startup, where I would meet an angel investor. I was one of these angel investors, I still am, and I invest $25,000 into a startup. And I don't see anything for 7 years, maybe ever, by the way. We got our start by simply going to angel investors and saying, how much capital did you put into early stage technology companies? How many of them worked? What cash flow have you received from your investments? And Brian, the average kind of response I would get was, I put about $1 million in startups. I've gotten nothing back, and a few look really good on paper. So it's like, okay, what if you had taken 10% of that, 5% of that, and put it into something that actually gave you cash flow immediately every month? But it's a revenue contract. So if the business slows down, you're going to get less. But on the flip side, if that business hits its growth plan and their revenue grows, you're going to share in the upside. And that's how we started. Mm-hmm. So Homegrown has been structured as a revenue contract that pays monthly cash flow to our investors. And here's what's important, that cash flow is coming from a company that has multiple locations. And why is that important? Well, sometimes expansions do not work. everybody listening to this podcast or watching this podcast has probably had an experience at work where you do something and it doesn't work. We know that that will happen. And so by backing companies that already have an established portfolio of locations, we sort of get an immediate diversification, and a diversification that gives us downside.
Yeah, you're not betting on the cash flow of the new location.
No.
You're saying the overall business has cash flow, has revenue coming in, and you have the right to a certain percentage of that. Is it for a certain amount of time that you have it, or for a certain amount that you have it, or when are they done?
Yeah.
And when are they done paying you?
Yeah. So basically, it's kind of a capped return model. Okay. So an average homegrown revenue contract looks something like, I give you $100,000 in exchange for 2% of your revenue. And you will share that with us monthly until you've paid back somewhere between 1.3x and 1.6x, give or take. Okay. So the first question an entrepreneur is going to ask is like, well, what's the cost? And where we position ourselves is sort of between the merchant cash advances that are, short-term instant, right? They're not doing, like, they're not going to have a conversation with you to understand the nuances of your business and understand risk. They're not doing that. They're looking at your cash flow and alternative data around the cash flow and saying, we're going to extend you credit for 14 months, but we're also going to take 15 to 20% of your sales every single transaction, right? So we're saying, we're going to actually talk to you. We're going to extend this credit for longer. But for that work, for that trade, we're also not going to take 15% of your daily sales. We're going to take 2% of your daily sales. One of the things that is really important to us is risk management. And a way you manage risk is by protecting the cash flow of the borrower. And this is a fundamental way that we underwrite. It's like, is this going to be a net positive for the business? And if the answer is no, we will not do a revenue contract.
And I can identify with that. We have said a similar thing about the way that we finance real estate projects, because we're very concerned about the cash flow going into the collateral. And
Yes.
the actual, in your case, that's the engine,
Correct.
And if you're taking too much cash out of it, you're actually adding risk to your own investment.
That's right.
In the end, I agree with that.
That's right.
So, well, that's great. I appreciate you outlining that, because I think it's very novel. It's a really smart way to finance small business. And I think investors are going to be excited about it. They already are. So I wanted to touch on something else that you've written about that I find really interesting. I think if I'm not, I hope I'm not misquoting you, paraphrasing you wrong, but you've put this idea out there that the brick and mortar businesses can act as an AI shock absorption layer. Can you unpack what that means?
Yeah.
And why that matters?
So my last job before founding Homegrown was at Microsoft. I'm a nerd. I mean,
I worked at Microsoft early in my career as an intern.
Man, we have so much overlap.
Look at that.
Yeah, I did.
I know. Amazing.
This is layers, man.
Crazy.
I saw a long time ago where AI was heading. I'm not saying I knew the future. I didn't. And I didn't know the timing of it, but you could look at the signal 5 years ago and sort of extrapolate out that, hey, in the next 10 years, we're going to face a really important moment in human history and in our markets where AI is going to get distributed in a way where it's widely available. And that has happened. I remember leaving Microsoft to start Homegrown, and one of my colleagues is like, you're leaving technology to like go do brick and mortar? Are you sure? Like, are you basically it was like, Michael, are you crazy?
Yeah.
And I was like, a little bit. You got to be a little crazy to do a startup. But I also believed in supporting a world where AI was more distributed and where the job dynamics were different. When we have looked at the last even just a year, you're seeing evidence of very real job dislocation. Now, many people will tell you, well, any sort of new technological wave comes with the destruction of jobs and the creation of jobs. And that is correct. However, you can't just say, well, some will be created and some will go away, so therefore it's fine. It's like, no, like you just said some jobs will get destroyed. What do you do here? It's our contention that coffee shops, yoga studios, restaurants, doctor's offices, and all the types of places that we back are important career points for people. They're important landing points for people. And it also offers a new type of entrepreneurship. I remember 10 years ago, constantly was hearing everybody talk about doing a technology startup. And I still hear this from,
Sure.
like the 19, 20, 21-year-olds I talk to. More often than not now, though, I'm hearing, I want to start a fitness concept in my city. I want to open a coffee shop. I'm hearing way more brick and mortar entrepreneurship. And we want to be a part of supporting that layer because we think it's how we respond in part to AI. It's not the totality of the solution.
Right.
To be clear, like the solution is going to come from many more places, but I do think what we do is a part of it. So that's what I mean. I mean that by supporting brick and mortar entrepreneurship, creating the jobs, helping to shore up the parts of our cities that we love and that people go to, that it's one way we can respond and give people opportunity.
I love that. That's awesome.
Yeah.
Very inspiring and cool. Safe to say you're building this in a pretty dynamic environment.
Yes.
Never a dull moment
Never a dull moment.
in our macro world right now. There's economic uncertainty, whether it's because of AI or other factors. There's a lot of innovation in financial products. I mean, that's for sure. There's last 5 years, especially since COVID, has seen a real positive explosion in that. How are you positioning Homegrown to stay resilient
Yeah.
in this environment?
In one of our presentations, there's a quote that the best downside protection is preventative medicine. We are very, very thoughtful about who we partner with, and we do a lot of work to make sure that when the shocks happen, they have the financial structure, the team structure, the location selection kind of prowess to be one of the companies that endures. I think that's one way we've responded is just doubling down on risk management and being very thoughtful. I think another thing we have done is thought very carefully about structuring of products. So, it's important going back to cash flow. It's really important when you're partnering with a business to think about their cash flow dynamics years out and to actually share your learnings with them. So something we do, there's a lot we do that's not on our website. One of the things that we do is we work with the entrepreneurs and sort of give them the insights we find through underwriting and to try to help them think through what's going to happen in a year and what happens if that build out that you thought was going to cost 500K costs 700. What's your plan? How much redundancy do you have in your capital stack? Do you not have enough redundancy? Well, then let's think about how do you build more redundancy? Because we know that a business that is performing and doing well that we have partnered with, probably is pretty compelling and probably has options. And we think it's important that companies have a variety of levers to pull financially to make sure that they can survive and thrive and weather the tough times. So I think that's some of how we respond to it. I think one more thing, Brian, is simply that, I'm a credit head. You and I have been reading the same articles the last month about private credit and the redemption and the redemptions that have been taking place. And there have been a lot of people who've been concerned about that. And so I get this question of how do you feel about it? And what I tell people is that is one category of credit. We're in another category of credit.
Right.
That doesn't mean anyone's immune from, geopolitical risk that we're seeing.
Sure.
Everything's connected, right? We're all in an ecosystem. But I do think that people are going to get their haircut. And I think that you're still going to go buy coffee and you're still probably going to go to the gym and so on and so forth.
Right.
I think we're funding, spend that works into the rhythms of people's daily lives. And that rhythm is protection for us.
Right.
To have it.
Yeah. And I think being location based is itself a form of protection.
Yeah.
Because people still need to be in a location.
That's right. And it's tangible. There are apps that I used to love 4 years ago that I haven't opened in a year.
Correct.
That happens.
Now, I mean, you also, and I appreciate how hard this is to do. I did it as an entrepreneur in specialty finance. You've now done it. You've built a good investor base.
Yeah.
pretty quickly.
I love them.
And I think I like your story about how you pitched it to the angel investors. Said, well, what if you just, what if you went from $1 million in this and zero in this to like maybe just balance it
Yeah, a
differently,
little bit,
right? I love that.
a little bit.
What do you think resonates with investors about this, and what's brought them to you? Why are they choosing to partner with you? I mean, getting investors over the hurdle to actually back, your company, of course, that's one thing, but
For
then
sure.
the platform is one thing, but then getting them to back the projects and the investments. I mean, I can appreciate how hard that is. What do you think has made you successful at that?
Man, the beginning was super hard because it was a very, very new, it's still a really new asset class, but there was like, whenever I talk to people about this, they're like, wait, what is this? Um, so first off, to any of our investors who are listening, thank you for taking a chance on us. Um, so the thing our investors love about Homegrown, and I think the ranking of why they partner with us repeatedly, we have a really high repeat rate with our investor base. I think the reasons are first and foremost the regular return. So I remember on our first revenue contract, I'm an investor in my first revenue contract. I love investing in my own work. Um, I remember talking to one of the investors, and he's like, "What's the risk?" It's like, "Well, the risk is that this company survives for 16 to 18 months, and they go out of business. That's the risk." And he said, "He's like, okay, but if that happens, I would have gotten something back." It's like, that is correct. You would have gotten something back. There's
Some portion of that 16 or 18 months, they're
for sure,
paying 2% of the revenue.
for sure. And many people are doing zero sum equity investing where it's truly a binary outcome effectively. And so I'm like, hey, this is probably not a binary outcome. This is like, there's a range. We think the range is, the probabilities, if you do the probabilistic analysis, most outcomes land in a really, really great, compelling spot.
Yeah.
But I think in credit, you need to be very downside focused. We are very downside focused.
Mm-hmm.
And I think just being very direct with investors about the risk. Like, I don't trust anyone who's like, well, there's no risk. It's like, no, there's always risk. Tell me the risk clearly so that I can make my own informed decision. And so I think that was part of it. Monthly cash flow and the knowledge that even if an investment didn't work, you'd get something back was how we got started. I think the second thing is the return. We offer what I will say is a fair and compelling return to our investors. It is risk adjusted and compelling and very good. Um, I think anytime you have a new asset class, you need to have like an early, kind of an early mover risk premium that you're
It's got to be
providing.
worth it.
Yes. And so we have provided that. I think that's the second thing. The third thing is something less financial and more soulful, which is the feeling you get by backing these entrepreneurs.
Yeah.
Like, Brian, I will tell you, we're sitting in a great neighborhood in Atlanta, and across the street is a business we backed.
That's awesome.
Like, it does great. It didn't exist 6 months ago.
That's awesome.
Like, my money, my dollars,
Yep.
alongside about 15 other people, and
Yeah.
went into that unit.
Yeah.
And I love going in there. I love talking to the staff.
Yeah.
I'll randomly buy someone a coffee and like walk away, and I get to see their joy. And I'm like, this is all happening in a space that like didn't exist before.
Yeah.
And so we've got that all over Atlanta and all over the country now.
Yeah.
And
And by the way,
pretty
when
cool.
you can invest in a lot of different things, it's nice to put your money in something that you can feel good about
Yeah.
and experience yourself.
Yeah, that's right.
I agree.
That's
All
right.
right. So as we do with every guest, and you're one of our first few guests, you're early. Love that. We like to end with a round of rapid fire questions.
Love it.
You can answer them with the first thing that comes to mind. You don't
Okay.
have to. You
Okay,
don't have to-
one overthink.
Yeah, you can just knock them out. What's a trend in private credit that people are underestimating?
Brick-and-mortar credit.
Love it. What's one red flag you never ignore when you are evaluating a business?
An expansion plan that is unrealistic and highly aggressive, and that depends upon miracles to come to fruition.
Perfect. How about a recent aha moment you've had while building Homegrown?
So this is maybe less of a an aha moment, but there was an articulation of creditworthiness that I loved. And I wish I could source the manager who said this, but he said something along the lines of, "We look to partner with companies that earn their cost of capital." And I loved that. It was such a pithy way to articulate, you know, making sure that when you were extending funding to a company, you're making sure that that business has fundamentals that can actually support the obligation. I just love the way that that was articulated. So
That's very cool. Earn your cost of
earn your
capital.
cost of capital.
I'm going to think about that.
Yeah.
Any favorite books or podcasts you listen to?
Oh, my favorite book. I love reading. I'll give you a book and I'll give you a podcast. My favorite book as of late has been The Hard Thing About Hard Things by Ben Horowitz. I have read it 4 times.
Such a story about how he took that company public
Oh my God.
out of
Yeah.
the ashes.
Yeah. And it's realistic. That's the thing. I read it when I was at another startup. I read it when I was doing venture investing. I read it at the beginning
it's
of
been out for a
Homegrown.
while.
Yeah. I'm like truly
It's a
gone.
classic.
Honestly, I keep losing track of if it's the 4th or 5th iteration. I think that's a great book.
And
on
any
entrepreneurship.
book that starts each chapter with a quote from a rap lyric, I mean, it's just,
It was so good
I love it.
and unexpected. So I think that's the book. The podcasts. Before my wife and I moved back to Atlanta 6 years ago, we were in Seattle, and around that time, there's this podcast called Acquired that came out. It's very popular now. Acquired still is one of my favorites. The new episodes on Ferrari that just came out. Really excited.
I've heard that's good.
Yeah.
I'll check it out. An investing habit or process that you always try to follow?
I think there's been this huge push towards algorithmic everything, and I understand it. And I think it's a perfectly worthwhile strategy. Like, it works for people. I think there's something still very magical about sitting down and talking to someone. Just an unremarkable, perhaps short conversation, just to talk. And I never personally have invested in anything where I can't talk to the entrepreneur at least once, or get a significant appreciation for what it is that they've created in the world.
Yeah.
I think, look, I love finance. I love math and numbers and competitive philosophy, everything. But there's something still very powerful about just talking to someone.
Love it. If you weren't in fintech, this is the last one. What do you think you'd be doing?
I would be back in biotech. So early on in my career, I did a very random, hard pivot into commercial strategy and early stage biotechnology and fell in love with it. And so what a lot of people, if you look at like my background, you'll see all sorts of things. I don't put like much online about it, but like a good 5 years was doing like pretty hardcore competitive strategy and commercialization for biotechs, oncology companies. I love biotech and I love healthcare. Homegrown is such a mission for me. It's like not a job. I'm going to be doing this for a long time. But I think in 12, 15 years, if I go do something different, it will be back in healthcare biotech.
That's a great place to wrap up. I appreciate you spending time with us.
You too, my friend.
Thank you very much. I think what you're building at Homegrown is tapping into a much bigger trend. I think there's expansion of private credit. Private credit is more than just software companies whose cash flows are threatened by AI. There's such a broader world out there. And I think I really admire fellow entrepreneurs who have tapped into that and pushed into these places and then done the hard work of finding a place to put the capital to work and then giving investors the confidence to do that. I think it's an incredibly important part of our.
Thank you, Brian. That means a lot. You know how hard it is to build something. You've built something truly beautiful and enduring here at Groundfloor. So it means a lot.
I think you're on the same track. And I also think, the most interesting opportunities for investors lie there. They're in these spaces that people like you and I are trying to find. There are a number of entrepreneurs who I've intersected with, an increasing number over the decade, 13 years now. It's fun to see how different people think about these markets and how some of the stories are the same in a lot of ways. But I think this is a really great time to be an investor. It's why we started our company, because we felt like there would be a lot of opportunity like this out there, and it's really gratifying to see it happening the way
Yeah.
it is.
You guys pioneers.
Oh, we were not alone, and we took a lot of arrows, but thank you. For our audience, you can connect with Michael via his LinkedIn. We'll include that in the show notes. You can also learn more about Homegrown at joinhomegrown.com. You can check out all episodes of this podcast and suggest a future guest for us at groundfloor.com/podcast. Please like and subscribe wherever you tune in. And thank you for joining us for Beyond the Stock Market.